Silver just broke the war trade, and that is not supposed to happen. In a normal panic cycle, missiles fly, oil spikes, gold catches a bid, and silver usually follows the fear. But this time, silver snapped out of that script. It surged with the conflict narrative, then suddenly broke character. And when an asset stops behaving the way the market expects, that is when the real risk begins. Because the next move is no longer about headlines. It is about positioning, liquidity, and whether the market just exposed a much bigger crack underneath the surface. What happened here is bigger than one red candle or one ugly session. Silver ran as traders piled into the same war trade everyone knows. Safe havens, energy, defense, hard assets. It made sense on the surface. Geopolitical stress was rising. Inflation fears were already alive. Central banks were cornered. And silver looked like the perfect instrument to capture all of it at once. Monetary fear, industrial demand, momentum, and panic. But then it broke. Not just in price, in narrative. That matters because markets rarely punish the obvious story first. They punish crowded positioning. The moment too many people are leaning the same way, the trade becomes fragile. All it takes is one shift in expectations, one stronger dollar move, one liquidation wave, one margin event, and the same trade that looked unstoppable suddenly becomes the source of forced selling. Silver may have just entered that phase. And this is where most people miss the point. They think the question is whether the war story is real. That is not the key question anymore. The key question is whether silver has already priced in too much of that fear too quickly, while ignoring the thing that actually moves markets in the short term: liquidity. Because in a real stress window, markets do not always sell what is weak. They often sell what is liquid. They sell what has profits. They sell what can be sold fast. That is why silver gets dangerous right here. It is not pure gold. It is not pure industrial metal. It lives in the middle. And when that middle breaks, the message is usually uncomfortable. It can mean traders are de-risking. It can mean dollar pressure is rising. It can mean the market is transitioning from emotional buying to balance sheet survival. And that shift can shock people because it does not feel logical at first. It feels wrong. But markets do not always reward what feels logical. They reward who understands the plumbing before everyone else does. Think about the sequence. First, fear explodes. Then silver runs because it looks like the cleanest expression of inflation plus geopolitical stress. Then traders start front-running bigger upside. Then the move gets crowded. Then volatility expands. Then one piece of the macro machine changes. Maybe yields jump. Maybe the dollar catches a violent bid. Maybe oil strength starts threatening growth instead of supporting metals. Maybe risk assets wobble and funds need cash. Suddenly, silver is no longer being bought for the story. It is being sold for funding. That is when things get wild. Because once silver breaks the war trade, every participant in the market has to ask a different question. If silver cannot hold the fear bid during geopolitical stress, what exactly was holding it up in the first place? Was it true conviction? Or was it leverage dressed up as conviction? Was it long-term demand or a short-term positioning stampede? Those are two very different markets. In the first one, dips get bought fast and the trend reasserts itself. In the second one, every bounce becomes an opportunity for trapped traders to get out. That is the difference between a healthy correction and a narrative crack. Now step back and look at why silver is uniquely exposed here. Gold can survive on monetary fear alone. Copper can survive on growth expectations. Oil can survive on supply disruption. Silver has to carry multiple identities at the same time. It is monetary, industrial, speculative, and psychological. That sounds like a strength in a bull market, but in a stress event, it can become a weakness. Because if one pillar starts to wobble, the others do not always save it. Sometimes they amplify the damage. For example, if the war pushes oil higher, the first reaction may help metals through inflation fears. But if oil stays high long enough, it begins to threaten growth. If growth fears rise, industrial demand expectations for silver start to soften. Then, if yields stay elevated because inflation is sticky, the dollar may strengthen. That puts more pressure on metals. So the same geopolitical event that looked bullish in week 1 can become a headwind in week 2. And if traders were positioned for a straight-line moonshot, that reversal hits hard. This is exactly why silver breaking the war trade is such a loud signal. It tells you the market may be rotating from headline panic into second-order consequences. And second-order consequences are where the biggest repricings happen. The first-order story is easy. War equals fear. Fear equals metals. Everyone understands that. The second-order story is harder. War can mean higher energy costs, tighter financial conditions, a stronger dollar, weaker manufacturing sentiment, reduced risk appetite, and cross-asset liquidation. That mix does not automatically help silver. In fact, it can trap it from both sides. And once that possibility enters the market, every rally becomes contested. Here is what most traders underestimate. Silver does not need bad fundamentals to fall sharply. It just needs the market to stop believing that upside is easy. Once that happens, momentum flips from friend to enemy. The same participants who chased upside start defending entries. Then they stop defending. Then they start exiting. Then stops get triggered. Then the chart becomes the story, and the story becomes self-fulfilling. That is how an exciting macro setup turns into a cleanup operation. But the real shock may not be the downside alone. The real shock could be what comes after it. Because when silver breaks a major narrative, it usually creates one of two outcomes. Either the break is the start of a deeper unwind, or it is a violent reset before an even bigger move. There is usually no sleepy middle ground. Silver is too emotional for that, too leveraged, too reflexive, too crowded when it gets popular. So what happens next depends on which market we are actually in. Scenario 1. This is a true unwind. In that case, silver's failure on a war headline is telling you that macro pressure is overpowering the bullish story. The dollar remains firm. Real yields stay uncomfortable. Growth concerns spread. Risk assets lose momentum. And silver starts behaving less like a crisis hedge and more like a cyclical asset with too much speculative heat. If that is the path, the market may keep punishing silver until positioning is cleaned out and expectations come back to earth. And that kind of move can be vicious because silver never declines politely. It hunts emotion. It punishes late buyers. It overshoots downside just as aggressively as it overshoots upside. The market does not simply drift lower. It shocks people lower, forces exits, and makes every dip buyer question whether they misunderstood the whole setup. But scenario 2 is even more explosive. In that version, silver's break is not a failure of the larger bull case. It is a flush. A violent shakeout designed to remove weak hands, reset leverage, and rebuild a stronger base. In that case, the market is using short-term macro stress to clean up the trade before the bigger move resumes. And if that is what is happening, then the rebound can be brutal in the opposite direction. Why? Because once positioning gets cleaned out, silver does not need universal optimism to rally. It just needs the selling pressure to exhaust itself while the underlying structural story stays alive. And that structural story has not disappeared. Debt pressure has not disappeared. Currency debasement fears have not disappeared. Geopolitical instability has not disappeared. Industrial demand themes have not disappeared. Central bank credibility issues have not disappeared. The ingredients are still there. So now the market is at a fork in the road. Was that break a signal of deeper weakness, or the setup for a more powerful second leg? To answer that, you have to watch behavior, not opinions. Watch how silver reacts to bad news now. If new negative headlines cannot push it materially lower, that tells you selling pressure may be burning out. Watch how it reacts to dollar strength. If the dollar firms and silver refuses to collapse, that is a clue. Watch the bounces. Are they weak, fading, and sold instantly? Or are they sharp, confident, and expanding in volume? Markets reveal their next chapter through reaction, not commentary. And that is why the next few sessions matter more than the last few weeks. Because when a narrative breaks, the first move is often emotional. The second move is informative. The first move is everyone reacting. The second move is the market telling you what it actually believes. If silver keeps failing after the emotional washout, that is dangerous. If it stabilizes and starts absorbing pressure, then the trap may be set in the other direction. There is also a bigger cross-market angle here that could shock a lot of people. If silver broke because the market is prioritizing liquidity over fear, that message does not stay isolated in metals. It bleeds into equities, credit, energy, and currencies. It suggests the market is becoming less focused on narrative trades and more focused on stress transmission. In plain English, that means traders may be starting to care less about the headline and more about what the headline does to the system. That is a much more serious phase. When markets move from story trading to system trading, correlations start changing. Good news can sell off, bad news can rally. Traditional safe havens can wobble, highly loved trades can break, and the people who get hurt most are usually the ones still trading the first headline, while the market has already moved to the second derivative. Silver may be flashing exactly that shift. And if it is, the implications are bigger than one metal. It means the market may be entering a zone where balance sheet discipline matters more than narrative confidence. That is when funds cut exposure. That is when volatility spreads. That is when the strongest looking trades become the first source of cash. And that is when people start realizing that this is not just about war. It is about fragility. Fragility in growth expectations. Fragility in disinflation hopes. Fragility in policy credibility. Fragility in risk appetite. Silver sits at the intersection of all of that. So when it breaks, it is worth paying attention. Still, do not make the mistake of assuming a break means the long-term story is dead. Markets are not that simple. Some of the biggest bull markets in hard assets include savage resets that convince everyone the move is over right before the strongest leg begins. The difference is timing. Long-term bullish does not mean short-term immune, and silver, more than almost any major asset, can stay irrationally volatile while the larger thesis remains alive. That is why disciplined traders survive this market and emotional traders get destroyed by it. If you are trying to understand what comes next, forget the dramatic commentary for a second and focus on pressure points. Does the dollar keep squeezing? Do yields stay hot? Does oil remain a tailwind for inflation, but a headwind for growth? Do equities start wobbling hard enough to create broader de-risking? Does silver begin disconnecting from gold in a way that signals industrial concern? These are the signals that matter now. Because here is the uncomfortable truth. Silver may have just stopped being a simple war trade and started becoming a macro stress trade. That is a different beast entirely. A war trade can run on emotion for days. A macro stress trade lives or dies on capital flows. It cares about funding conditions, real rates, dollar availability, growth expectations, and cross-asset positioning. That market is less forgiving. It is more technical, more violent, more deceptive. It produces fake-outs in both directions and punishes anyone who thinks one headline is enough to explain everything. And that is why what happens next could shock markets. If silver continues lower, the shock is not just the decline itself. The shock is what it reveals about investor behavior. It reveals that in a stress event, liquidity is king, and even popular safe haven adjacent trades can get sold hard. That would raise questions about how crowded other macro trades are and how resilient broader risk sentiment really is. But if silver suddenly regains its footing and rips back higher after this break, the shock could be even bigger. Because that would suggest the sell-off was a cleansing event, not a collapse. It would mean the market flushed weak hands, repriced leverage, and handed stronger participants a cleaner launchpad. In that case, the people who sold the narrative breakdown may find themselves chasing the rebound at much worse levels. And silver is exactly the kind of asset that can do that. It can terrify bulls on Monday and humiliate bears by Thursday. It can look broken right before the tape changes character. It can spend days building fear and then unwind that fear in a single explosive move. That is why it attracts attention in the first place, not because it is stable, but because when it moves, it forces the whole market to notice. So the smartest approach right now is not blind conviction. It is conditional conviction. Respect the break, respect the message, but do not confuse a broken narrative with a solved market. The market is not solved, it is transitioning, and transitions are where opportunities and mistakes both get magnified. If silver cannot reclaim strength soon, then markets may be entering a more defensive phase than most people realize. If it can reclaim strength despite everything that just happened, then the larger bull case may still be alive in a much more aggressive form than the pullback suggested. Either way, complacency is the one position that makes no sense here. Because the signal is already loud. Silver just broke the trade everyone thought it was supposed to love. That does not happen for no reason. Either the market is warning you that stress is spreading beneath the surface, or it is manufacturing maximum confusion before a larger move. Both outcomes matter. Both outcomes are dangerous. And both outcomes can shock people who are still trading yesterday's script. So now the only question that matters is this. Was this the beginning of a deeper unwind, or the final shakeout before silver rewrites the entire market narrative again? And maybe an even better question is this. If silver is no longer reacting the way the crowd expects during war, what else in this market is about to break next? Watch closely, because the answer may arrive faster than anyone is prepared for. If you are following this story in real time, subscribe now, because the next move in silver could set the tone for everything from metals to equities to the dollar. And tell me in the comments, Do you think this breakdown is real weakness or a trap before a bigger surge?